Welcome to S&P's European loan market video overview, detailing leveraged finance trends and activity during September 2011. I'm Suchit Gupta, a member of S&P's Leveraged Commentary and Data Team, a unit of S&P that is not affiliated with S&P Ratings. For the next few minutes, I'll walk you through a review of recent loan and high-yield bond market trends in Europe, before winding up with themes to watch for in October and early November 2011. Before we start, please know you can follow LCD on Twitter, Facebook, and can join the almost 6,500 contacts in LCD's Leveraged Loan Group on LinkedIn. The links to follow LCD are in the info section on our YouTube channel. You can also download the slides for this video at slideshare.net. September didn't provide any relief after what was a tumultuous August. The ongoing and seemingly unending Greek sovereign travails, coupled with regulatory uncertainty, continues to bring unadulterated misery to both the primary and secondary markets. The secondary loan market finished the month down 132 bips at 92.66, while high-yield bonds finished the month down 676 bips at 85.06. This declining secondary market has forced banks and investors to launch price discovery on deals that are currently out to the market for new loans. Loan issuance stood at $3.2 billion for the month of September, while high-yield bond issuance stood at $1.2 billion. The S&P European Leveraged Loan Index, the LE, had a negative return of 1.95 ex-currency for the month of September. Even with repayments of $4.2 billion from Nycomed, $1.5 billion from Previmi, and $1.4 billion from Comham, and only $3.2 billion of new issuance in September, the supply-demand imbalance is still in favor of investors. Investors are shedding risk, and very but a few are reloading on risk by taking up some of the primary paper. Arrangers are being forced to reevaluate all their deals, and there is talk that some of them are willing to accept significant OIDs to get the deals off their books. The high-yield market is close to all but a few crossover credits, 4B types, for now. Default rates remain stable. Focusing on the secondary loan market, this chart details the average price of LCD's European Loan Flow Name Composite, a measure of the 14 largest, most liquid loans consisting of 10 issuers since 2002. The flow names fell on 132 bips to close the month at 92.66. The flow names did, however, bounce 20 bips during the month, but closed the month at a range last seen in October 2010. This next chart details the average price of LCD's European High-Yield Flow Name Composite, a measure of the 12 most liquid high-yield issues since the beginning of the year 2010. The high-yield market fell 676 bips during the month to close the month at 85.06. The high-yield market has been far more affected by the volatility than loans. High-yield flow names are down 1,218 bips since the beginning of the year, while loan flow names are down just 484 bips since the beginning of the year. This next chart details the monthly return of the LE, a broad measure of European loan market that LCD calculates. The European loan market posted a negative return of 1.95 for September 2011, down quite significantly from the negative 0.84 seen in August 2011. For the year to date through September 30th, 2011, the LE has returned negative 1%. For the same period last year, the LE returned a positive 5.07%. Now we turn from the secondary to the primary. This graph details new issue volume for both leveraged loans and high-yield bonds. New issuance for leveraged loans during the month stood at 3.2 billion euros, up quite significantly from the 63 million euros seen in the month prior. High-yield bond volume stood at 1.2 billion euros from 3 issuers, up significantly from the nil seen in 2011. Default rates, however, remain stable. The default rate by principal amount stands at 3.79% at the end of September, up from the 3.77% in August 2011. The default rate by issuer count now stands at 2.59%, compared to 2.62% at the end of August 2011. In summary, the fallout from the sovereign risk contagion shows no sign of abating, as confidence weakens in the broader capital markets, and there's still a lot of uncertainty regarding the impact of regulation. The fall-off in loan prices is not as severe as the drop in high-yield prices. The high-yield market is all but effectively shut for all but 4B/crossover credits for now. In September, the three issuers that issued high-yield bonds were Fresenius, Heidelberg Cement, and Peugeot. Given the lack of clarity on the secondary market, investors are extremely reluctant to commit to transactions that arrangers are bringing out, even with the changed economics and terms. It's creating a blockage as banks become increasingly reluctant to commit to new financing until the existing overhang is off their books. We could be left with a situation where banks are not able to commit or underwrite, even though private equity sponsors still have a significant amount of dry powder to deploy this year and next and the year after. That brings us to the end of our overview. I hope you found it informative. We'll update the analysis each month and plan to have analysis of other European market segments going forward. Check out LCD's YouTube page for other video analysis of the leveraged finance market, including US loan market wrap-ups. The link to the page is in the description for this video. For more information on LCD news or research in Europe, you can contact Anna Cini. You can email her by clicking on the link in the info box. Thanks very much. We'll see you soon. Before getting down to business, some fine print. This disclaimer, courtesy parent company Standard & Poor's and McGraw-Hill, covers all the bases. Please read it at your leisure.